Okay, folks, welcome back from the break. Thanks for coming back from the break. I hope there's not super crunchy chips in those bags. Let me also say thank you for coming here today, and for those of you on the webcast, just to emphasize what Stuart said at the beginning, we really appreciate your interest and engagement in our company and our story, and I can't wait to tell you more about it here in the next few minutes. More coming in here. Really excited about our new image. We stood here 2 years ago, almost to the day, with a very recently transformed KBR at the time. We had a pretty new management team, and we then laid out some pretty aggressive long-term projections or targets, if you will, based on the underpinning view that we had a more stable, predictable business from the acquisitions we had made and the transformation that had undertaken. And as you've heard here today, we achieved those goals, and in fact, we exceeded them. It was fun to hear our business presidents moments ago banter back and forth about who has the coolest job, the most interesting job, the most challenging job. But through their hard work, I can confidently say, I've got the best job. No one said they had the best job, because I can rack up all the money and report these wonderful results. And for a CFO to do that, it is a terrific luxury to have. I won't say it's easy, but my colleagues and my teammates have made it a great experience. And you know, there's nothing like being on a winning team. Nothing better than being on a winning team. One of the reasons for that, and Stuart touched on this, is that we take commitments very seriously. We're all in as a team. We map out a chart for our future. We quantify what we want to achieve, and we help each other get there to deliver. With the old adage of KBR, since the very beginning, we deliver, we take super personal, super serious. We do that with ourselves, we do that with our customers, we do that with our employees. Commitments to our employees are super important, but here today, equally important, we make our commitments to you very seriously, the investment community, and we're very proud of that. You've heard over and over again today how we believe we have amassed a portfolio, an advantage portfolio, that happens to be very well aligned with priorities that our customers have in attractive markets. And we're pursuing them in a disciplined way to ensure that our efforts are profitable, they're cash generative, and we do so at increasing scale. We really like scale. Greg referred to about 185 opportunities in our pipeline that are $100 million or more in revenue potential each. Those move the needle opportunities really accelerate our scale. Scale benefits us in several ways. It benefits our momentum, which is very important for a team. Also benefits the bottom line. Scale benefits the bottom line. I'll talk about that in a little bit later as well. So because of all of this, our advantage portfolio, the team we have, the recent wins we've made, we think we can do more. There's more we can achieve. And so because of that, we are raising our long-term targets today. I'll walk through each of them. We're raising our targets for long-term earnings, the highly predictable cash flow that comes from those earnings, and importantly, we're reprioritizing our approach to capital deployment. I'll walk through this in pretty good detail, but with the attractive cash we expect to generate through our targets, we're going to, of course, prioritize achieving our targeted leverage. After that, we're prioritizing return cash to our shareholders. We think that really represents a very interesting value proposition in addition to the growth proposition that Stuart mentioned earlier. I want to walk through our finance strategy for a moment, and then I'll cover the building blocks of our long-term targets, starting with revenue, then margins, and earnings per share, and so forth in the slides to follow. But easy stuff. The finance strategy is composed of two main elements. On one hand, maximizing profits and cash flow, really complicated. And on the other hand, prioritizing our capital structure and our capital deployment to maximize value to our shareholders on a per share basis. Each of those has a couple of elements I'll walk through. For maximizing profits and cash flow, you heard Greg talk about selectively, strategically deriving parts of the market that are attractive, both to our customers and to us from a capabilities perspective, aligning our capabilities and developing them further to tap those markets more successfully, and pursue them in a disciplined way, of course, as I said earlier, to be profitable, cash generative, and scalable. I think I've repeated myself here. So, relative to maximizing earnings and cash, we talked about profits, cash, and scale. The next element is commercial discipline. We're very proud of the fact that we've built a much larger recurring services business and technologies business that not only has produced very good results for us that we've shared with you for 9 straight quarters, but it has also enabled us to be very selective in any lump sum opportunities we pursue. Very selective. We're very proud of the fact that we have undertaken a few lump sum projects since launching this strategy 4 years ago or so. And in the very few that we have engaged on, very carefully selected, they've all been successful. Very measured step into that territory. Commercial discipline, commercial selectivity is a core part of our strategy. Selectivity and success from a commercial perspective is not only core to our strategy, which I think we've demonstrated well, but it is really part of the new KBR culture. Our government folks learn all the time about commercial prowess and selectivity from our long-established energy and technology business. There's great synergy there. The third main element of maximizing profit and cash is cash is king. I talked about this 2 years ago. We've embarked on a number of activities across our business functions to make sure cash is always front and center in everything we do, from bidding to billing to collecting to even the disbursement side of the house. Maximizing cash flow velocity is a team sport. It's the ultimate team sport across a complex organization, across a global one, but we're getting better at it every day. We're well on our way to our journey to excellence there. Let me move on to the right side of this chart, the capital structure and capital deployment part. We've been very clear that we have a targeted leverage target of 2.75. That was 2 years ago. We retain that target today. We think that represents a really nice balance of making sure we have adequate capital and flexibility on one hand, but also minimizing our cost of capital on the other. We believe in terms of value creation, the smartest approach is to first achieve our targeted leverage ratio and then prioritize returning cash to shareholders, as I mentioned, through dividends and also buybacks. I'll talk more about this in the moments to follow. Now I want to walk through the building blocks of the targets. I'm going to start with revenue, and the next several slides talk about compounded annual growth rates or margins from the period 2019 to 2022. So that is our planning horizon, our targeted horizon. I'll start with the government business. We had original targets of 5 to 8%. We are raising those targets to 6 to 10%. Organic compounded annual growth over the next 4 years, including 2019. Why are we raising these targets? Well, the first reason is we've been exceeding them. We've been very proud to talk about double-digit organic growth for some time out of Byron's business and Andrew's business, all collectively attributing to that result. Second reason is our main customer sets, the Department of Defense, the Ministry of Defense, NASA, have strong budgets, and we believe there is compelling growth in those budgets in the foreseeable years ahead. The third reason is what Byron was talking about just moments ago. We have combined to our customers' satisfaction, I would say, and our customers are demanding the balancing and mix of our domain expertise, our specialized capabilities that we're further developing for them. But this global presence is a big deal relative to our differentiators to our customers and ultimately to our performance. We're seeing our presence in the UK and the Middle East and Australia, together with the US, really creating a lot of synergies. And that's a true differentiator for KBR that others in our peer group really don't have. I'll talk about the scale of that in a bit. So because of that, we think the amplification of our global presence to a strong market and the momentum we're on in terms of the contracts we've won justify bumping up our targets to 6 to 10%. Technology. This is a gem business for us. We had original targets of 7 to 10%, and this group has consistently met those targets and exceeded those targets since launching them at that time. They've had a compounded annual growth of 13.5% over the last 10 years, and that's through a very difficult financial period, 2008 to 2009. You'll recall that. They withstood that. And then the oil and gas difficulties, 2014, weathering through all that storm, very consistent growth and track record for this business. I'll also add that the technology business posted 48% organic growth in our first quarter 2019. So with that, I'll also add that you heard Doug. The markets here are healthy in terms of the N3 markets that he mentioned. The demand for our technologies are high. And when we think about KSAT and KPRO, just as an example, potentially game-changing sort of market dynamics with those deliverables. So we're super excited. I think it's a growth story in and of itself. So 10 to 14% targets for this business. And finally, energy solutions. We're raising our targets to 20 to 30% over the next few years. Organic growth. Last year, this segment did $1.2 billion in revenue. Jay's business, the man with the moves and the smiles and the grooves, was 2/3 of that. But right now he's growing double digit, and he is looking at $1 billion for 2019. Outstanding growth and leadership. Farhan's projects business has been advantaged from our patience. We have been very careful in only pursuing attractive projects. That actually brought us to a project volume low in 2018, with good reason. We did not take risky projects on. But we are coming from a low point. We've now won a few downstream projects so far this year. That moves the needle quite a bit, coming off of a low base. Even before LNG, we believe collectively these two can perform at the low end of this range. No LNG, 20%. One LNG, 30%. So at the KBR level consolidated, when you rack this up, we believe 10 to 14% targets are reasonable and justified by the building blocks I just walked through, with the low end of that range double digits still, no LNG, and the higher end of the range with just one. Let me give you a different cut at our view toward revenue growth over the next few years. Not by segment, but by type. This chart shows the buildup of the 10 to 14% compounded annual growth, starting in 2018, but going through 2019 and through 2022. With the blue part being our current book of business, the green part being new business from our pipeline. Those two together add up to the 10% floor of our targeted compounded annual growth rate of revenue, 10%. And then we've added the candle on the cake, if you will, the LNG layer, one mid-size, that gets you from the 10 to the 14. Let me talk about our book of business. We are really proud of the book of business we have today, and it is a number one reason why we've been outperforming the industry. This consists of backlog, options, recompetes, and renewals with our government customers and our commercial customers from the recurring work we do across our portfolio. Our backlog today with options is $17 billion. Our recompete win rate in government is over 95%, and it's over 85% in our commercial business that has repeat business. Our customers stick to us. Look at some of these programs that are some of our larger ones in that book of business. Andrew mentioned Aspire, 2041, 2033, 2029, 2029. So these programs that we have extend well beyond this planning horizon, provide a lot of visibility to us well beyond what we're talking about here. But together, that book of business comprises 60% of the stack of 10 to 14% compounded annual growth you see here over the next 4 years, 60%. 2019 has 90% already covered, as an example, coming out of the first quarter. This is what we call stable, predictable business. The next chunk, the green, comes from our new business pipeline. Totally new business. You saw Greg's buildup of our pipeline today. There's $40 billion of near-term pipeline, all new, that we are looking to source this part of the puzzle, the 40% on top of the 60 to get to the 10% compounded annual growth. We took a very conservative view of the success rate of the prosecution of that pipeline under our current win rate, amounting to this. And in addition, I'll point out that our technology business, as rock solid as it's been for performance, most of its business will come from that green section because it's a high churn business. But its track record is flawless. Again, the blue and the green get you to 10, one LNG on top, the additional 4. Takeaway here is we can deliver, or believe we can deliver, double-digit revenue growth over the next 4 years with no LNG, with a great book of business we have, and above that, should we undertake LNG, under the assumption we can make money at it. Very important assumption. So now that I've covered revenue, let me hit margins real quick. 2017 targets were provided here on the left. For our government solutions business, we are not seeing a change. We're holding steady at upper single digits. That's higher than some of our peers, particularly those that do a lot of NASA work and logistics work. We attribute that to our international business. Our international business does very strong returns relative to the domestic business, sometimes double digits. What some people don't understand is the magnitude of that. So our government, or international government solutions business, Andrew's business, for the rest of the world outside of the US, produces 30% of government solutions profit today. And it will continue to do a very healthy part because of our PFI programs. Our PFI programs account for the lion's share of that 30%, and they go out, in the case of Aspire, beyond that planning horizon of 4 years, another 19. Technology. We originally targeted upper teens, and the group consistently missed this target and went to the mid-20s, sometimes the upper 20s, sometimes beyond. We think the appropriate new target is mid-20s, where they've been consistently performing. And for energy solutions, Jay's business actually has great margins and no projected change in that, and he's growing very nicely, so that is certainly helpful here. However, we do recognize that we are of the view that we will enter into a cycle of more project contribution from Farhan's business. When we engage in new projects, we tend to have a very conservative booking position out of the gate, and for that reason, we think mid-single digits is an appropriate target for this segment overall. In the aggregate, it all balances out to basically where we've been tracking, no big change, upper single digits for the enterprise. Can you advance the slide? Thank you. Now let me transition revenues to margins to cash flow. No major change here. We're still targeting a 90 to 110% conversion ratio, which is defined as operating cash flow over net income. Over the past 2 fiscal years, we've done an average of about $180 million operating cash flow. This year, we're guiding $175 to $205 million operating cash flow. All those are well aligned to this conversion ratio of 90 to 110%. On a cumulative basis, you can see that it's roughly $200 to $300 million per year in operating cash flow. This aggregates to $800 million to $1 billion of operating cash flow over the 4-year planning horizon here. And of that, we expect to use about 50 to 75 on a cumulative basis for capital expenditure. We are a low capital intensity business. Let me just break this down into annual increments again, $200 to $300 million for annual operating cash flow. Annual CapEx is around $15 million per year, and our regular dividend is about $45 million per year. So you get to about $150 million plus of deployable free cash flow that we can use for other purposes. This gets to what we'll talk about in a moment. I should say that our targets are exclusive of any recoveries from the government, from ICDIS. We've talked about that. They're abundantly disclosed in our SEC filings. We've been conservative here to exclude them, but we do think those represent an interesting upside in the future. Hard to tell when. Capital structure. We have guiding principles on the left, and we have priorities on the right. Very quickly, we have no plans to change the low capital intensity business model we have today. On a consolidated basis, we actually run at negative working capital today with advances we get from customers from the government side and the technology side. It's pretty impressive. That's commercial discipline. Second, manage cash on a daily basis, team sport. Very important guiding principle that perpetuates everything we do. Third, make sure we maintain a balanced liquidity profile. Talked about that earlier, relative to our targeted leverage ratio. And fourth, maximize shareholder value on a per share basis. That's our job. That's why it's a guiding principle. On to the right, our priorities. First and always first, fund our organic growth opportunities. That represents the best return for a dollar than any of our alternatives. Second, reach our targeted leverage ratio of 2.75 on a gross basis. We see that happening in the fairly near term I talked about in the earnings call the other day. Third, return cash to shareholders. That includes dividends, but also includes share buybacks. And fourth, selective, accretive, and strategic M&A. Let me cover these latter two just a little bit more. Our business today, as you've heard throughout the morning is performing very well. We're able to meet our customers' very complex requirements all around the world with very distinct capabilities. We're able to attract great employees who stay and deliver consistently. And I mentioned again, all of this contributes to strong financial results that we've consistently cranked out. So for that reason, while we'll always consider M&A opportunities and think of them if they're very compelling, our first priority, given the strengths we have today, is to return cash to shareholders to maximize value on a per share basis. Here are the building blocks of our earnings per share targets. I've given you revenue, margins, cash flow. It all works itself into this. We start with, at the bottom, the revenue compound annual growth at constant margins on an aggregate basis, 10 to 14%. We benefit from scale. I mentioned that earlier. That adds 2 percentage points of growth, more efficient absorption of G&A cost, interest cost, 12 to 16%. Up the ladder, if we deploy just half of our deployable free cash flow, which is what we've modeled here, prudently and conservatively, we bump up another 2 percentage points. That's our target for the next 4 years, 14 to 18%. Should we decide to deploy the other half of the deployable free cash flow, we have the opportunity to go above this targeted range. Should we decide to pursue it with more than one LNG, upside here as well. We'll play those cards as opportunities are considered in the years ahead. Let me try to wrap it up. We are seeing impressive growth throughout our business, in most areas of our business right now, and we have a strong market outlook. Our margins are holding up. No major change there. And we've already delivered on our cash flow conversion consistently. No major leaps there. So we believe, for these reasons, we are a true growth story, collectively and in each of our markets. And because of that, and because of the team we have are raising our targets, I walked through them today, and this is a summary of those targets. Again, moving from left to right, revenue 10 to 14, margins upper single digits, adjusted EPS 14 to 18, cost conversion 9 to 110. We're adding another one. We very much want to be aligned with shareholder value creation. So we have a return on invested capital target, which will gauge our success in how well we deploy our capital and how well we generate returns with the capital given to us, of 12% plus by 2022. I think we've laid out a case for a growth story. I think what's very interesting is the value proposition here as well. We see abundant free cash flow coming out of our business. We're using some of it in our growth story, but we're leaving a lot on the table for potential additional value creation that will amplify and could amplify our growth story. And we think that's really exciting, and that's really what we wanted to share with you most today about the financial picture here. Now, what makes this all possible, the reason I came to this company, is an incredible strategy, incredible leadership team, but most importantly, the fabric of the people we have. 38,000 people now, it's grown a lot, but they are absolutely fantastic. We've told you how great they are, but I think you should hear from them how cool it is to work at KBR. So we have a video to that effect, and then I'll turn it over to Stuart.
KBR is in technology, aerospace, and defense.
Global, diverse, and service-oriented.
We consult, we supply, and we support.
We execute, we innovate, and we deliver in energy and chemicals.
I've seen how KBR's team culture has been effective because it's collaborative and not competitive.
I remember, engineers coming to me and saying, if you need us to explain something to you, we're more than happy to do that.
The opportunities to travel with KBR have been immense.
The company also helps you develop yourself and direct you in the path that you want to go within the company.
I have really appreciated their investment and commitment to me. I know that that means they believe in me, and it makes me a more effective employee.
In no other place that I've ever worked have I been able to engage on projects across the business spectrum all around the world, pretty much every single day.
I've lived in multiple countries on KBR projects. From one day working on a project in Saudi Arabia, and in the afternoon I'm working at NASA. Being able to touch a lot of projects, meeting a lot of fantastic people.
I've been able to develop relationships and friendships with coworkers and customers and partners from around the world, and it's been tremendously rewarding.
Everyone is incredibly authentic, helpful, and there to make you feel like you're part of the team.
The type of company KBR is, you get to work with lots of different people from different cultures, from different backgrounds, and from different age groups.
The people that I work with at KBR are fantastic. They're extremely smart, they're experts in their field, and they really care.
The company really cares about giving back to the community and allowing its employees space to be participants in that. It creates another level of relationship beyond the professional realm, and I think that is really invaluable and that I appreciate.
Don't underestimate the opportunities at this company. I'm really amazed that KBR has been this defining in my career and thus in my life.
KBR is so broad in the areas that it participates in that there is something for everybody. From engineering to technology to aerospace to defense, KBR will allow you to grow and advance your career as much as you want to.
As long as you have the interest and as long as you have the passion and the desire, the company sees that within its employees and encourages them to do that.
I've seen in my own story at KBR that there is actually no limit to personal achievement. It's just a matter of deciding your path and delivering.
Throughout the company, no matter where you look, there's going to be something amazing, diverse, unique, exciting going on that really makes you proud to be part of KBR.
So what do we do at KBR? We deliver together.
We deliver together.
We deliver together.
We deliver together.
We deliver together.